40-year fixed rate mortgages are being advertised by a number of lenders in the marketplace right now. And given today's sales prices at current rates, it's nice to have an option where the monthly payment could be lower, right? But what is the additional interest expense for those additional 10 years in term? Let's take a sales price of $420,000. That's a current median sales price here in the US. Let's assume 5% down, so it's $399,000 in mortgage. And let's use an interest rate of 6.875%. That is the current average for a 30-year conventional mortgage here in the US, according to Mortgage News Daily. So comparing the 30 to the 40-year term, the difference in monthly payment is $178. However, the difference in interest when you compare the 30 to the 40-year term is $229,000. So if you take that 40-year term, you're increasing your interest expense by 42% for the sake of saving what amounts to be about 7% in your monthly payment. Much better to go with a 30-year term versus the 40-year term. If you do need to take a 40-year term to qualify, you'll want to figure out what it'll take to pay the mortgage off in 30 years, if not sooner. And if you do this, you're going to save a big chunk of money on interest, and you'll gain equity faster. So when it's time to sell your property, and you may very well not keep the property for 30 or 40 years. The average length of ownership on a property here in the US works out to be 12 years. But when it is time to sell, if your balance is lower, you'll have more net equity. You'll walk with a bigger check from the sale of your home. And who doesn't want that? Now in the description below, you'll find a link for my mortgage calculators. And you can run your own numbers. If you have questions, you can connect with me via my LinkTree. And if you want to learn more about credit, financing, or real estate, please be sure to like, follow, and subscribe.